Welcome to The Explainer. Today, we're cutting right to the chase and tackling a question that's probably on your mind. What is the absolute smartest way to grow your money heading into 2026? We're going to skip the noise and give you a really practical, no-nonsense guide. So let's start with this. What do you think is the biggest threat to your portfolio? Is it a surprise market crash, some kind of recession, or could it be something that's hiding in plain sight? The answer might actually surprise you, and getting this right is totally critical for your financial future. Most people's gut reaction is to point to the ups and downs of the market. But what if the real danger, the one that's quietly eating away at your wealth every single day, is the one thing you think is the safest? I'm talking about cash. That perceived safety is a trap, and it could be costing you way more than you think. Okay, so let's just completely debunk this first myth right now. The whole idea that your savings account is some kind of safe haven for your money. I get it. High-yield savings accounts are looking pretty tempting right now. I mean, you see rates as high as 5%. And on the surface, that sounds amazing, right? A fantastic risk-free return. But there's a lot more to this number than what you see at first glance. So this is where that pretty picture really starts to fall apart. See, that 5% isn't what you actually get to keep. Not even close. First, the taxman comes for his cut of that interest. Then, you've got inflation, which is just constantly chipping away at what your money can actually buy. And here it is. This is the brutal reality. Once you factor in both taxes and inflation, that awesome-sounding 5% yield actually becomes a negative real return. Let me say that again. Your money is actively losing buying power while it's sitting in that so-called safe, high-yield account. It is a silent wealth killer.
Okay, so if stashing cash is a losing game in the long run, what's the alternative? Well, investing in the market, obviously. But that brings us to another huge, and I mean huge and costly mistake so many people make, waiting for that perfect moment to jump in.
The historical data on this is just crystal clear. Over the long haul, the stock market has been an absolute beast of a wealth creation engine. Just look at these numbers. It doesn't matter if you're looking at the last 5, 10, or even 30 years. And remember, that includes bubbles bursting, crashes, recessions, the whole shebang. The S&P 500 has consistently delivered really strong average returns. And hey, if you're still not convinced, get this. This is a staggering fact. If you missed just the 10 best days in the market over a 20-year span, it would have cut your total returns by more than half. That is a massive, massive price to pay for trying to be a psychic. And this quote just nails it. The expert consensus is simple. Don't try to be a market timer. It's a fool's errand. Instead, just focus on being a consistent investor. Your time in the market is so much more powerful than timing the market. But here's the thing, even if you understand all the numbers and you're committed to being a long-term investor, there's still one major hurdle that can totally derail you. And this opponent, it isn't the market. It's you. It's your own brain. See, we are all hardwired with this psychological glitch called loss aversion. And all it means is that the pain of losing $100 feels about twice as bad as the pleasure of gaining $100 feels good. This emotional imbalance, well, it can lead to some really, really bad financial decisions. Have you ever felt that sick, gut-wrenching feeling when the market is dropping and you just want to sell everything? Or that intense FOMO, that fear of missing out when a stock is just rocketing upward? Yup. That's loss aversion at work. It's that emotional force that pushes us to do the exact opposite of what we should, buy high and sell low. But here's the good news. You can absolutely fight back against this. It's not about being a robot, it's just about being smart. So, step 1, stop checking your portfolio every single day. You're just asking for an emotional reaction. Check it quarterly. Step 2, just acknowledge that this bias exists. Just knowing about it is half the battle. And step 3, maybe the most important, have a plan and stick to it. Tune out the daily noise. Okay, let's talk taxes. I know, it's not the sexiest topic, but trust me, it is one of the most important. Because at the end of the day, what you make is one thing, but what you actually get to keep, that's what really matters. When it comes to investment taxes, timing is literally everything. If you sell an investment you've held for a year or less, bam, you get hit with higher tax rates. But if you can just hold on to it for more than a year, even just one day longer, you qualify for much lower, much friendlier tax rates. It's that simple. Let's just look at Bailey's situation here. It's the same $500 profit. But just by waiting a few more months to sell, Bailey saves $35 in taxes. Now, $35 might not sound life-changing, but imagine that effect compounding across your entire portfolio over decades. It's a really simple trick to keep more of your hard-earned money working for you. So, what does this all mean for you right now, today? It's time to pull all these lessons together into a simple, totally actionable playbook for investing in 2026 and beyond. First, just a quick practical heads up on the plumbing of the market. Things are moving faster than ever. As of mid-2024, stock trades now settle in just one business day. It's called T+1. All this really means for you is that when you buy, your cash needs to be ready to go sooner, and when you sell, you get your cash faster. Simple as that. And here it is, your whole 2026 playbook in a nutshell. 1. Think in real returns after you account for taxes and inflation. 2. Prioritize your time in the market. Consistency will always beat timing. 3. Master your own psychology. Know your biases. 4. Be smart about taxes. And 5. Just be aware that the market settles faster now. That's it. So I'll leave you with the same question we started with. What is the biggest risk to your money? Is it the short-term ups and downs of the market? Or is it the slow, silent, mathematical certainty of your wealth being eroded by inflation if you do nothing? The choice really is yours.